Well, good evening, investors, and welcome to our March 2022 edition of the Roundtable. We have labeled this Time-Honored Traditions, and we'll get to that in a minute. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by a couple of very dear colleagues. First, Ken Kavula, my neighbor to a few miles to the north. Good evening, Ken.
Good evening. Glad to be with you this evening.
And from Peachy, Georgia, Guy Lynch.
Good evening, everybody. And it is peachy and wonderful down here, turning very yellow with the pine pollen as well. So.
Oh, yeah, that's in our future, too. And Cy is absolutely rejoicing over the return of baseball. And I kind of share that sentiment a little bit myself also.
Absolutely.
Kim Butcher will be unable to join us tonight. In fact, she just turned her stuff in and a few minutes later called with the bad news of the death of a family member. And she's going to take the night off, and we all send our thoughts and prayers in her direction. All right, so I have titled this Time-Honored Tradition. You'll see which time-honored tradition we are actually having a good time with. The hint is right on the cover slide. I'm inspired by the daylight savings time change, and you know how when they have to move those Stonehenge rocks around with the bulldozers to that 1 hour time difference every year, and there's a pretty good chance they're not going to have to do that anymore if we do away with daylight savings time. But
Mark, there was an editorial in our paper up here about that. Do you remember experimenting during the oil embargo crisis in the early 70s with keeping us on daylight time throughout a couple of years? Do you remember doing that?
I do vaguely remember that.
Yes, I do as well. I was
evidently the pushback from anybody that had small children that were going to school was terribly it was a very serious problem because kids were getting up and walking to school and walking to bus stops and doing it completely in the dark. And it wasn't just a week or two of dark, it was the entire season where they went to school in the dark. A lot of research being done also on the disruption of circadian rhythms when you get up and start your day before the sun comes up. So be careful what you wish for was the title of the piece that was in the paper. I know that I still read papers, and I'm one of 11 people left in the country that still read papers, but I'll be interested to see what the reaction will be if we in fact move in that direction, and then kind of wait for a year and see what the reaction of a lot of parents is as far as the new times that they won't be used to and the darkness happening in the morning rather than in the evening.
Well, I'm already drinking circadian coffee, so I think I'll probably be all right.
You're all right then? Okay, good.
Well, that one time-honored tradition we're going to visit and celebrate here in a minute is to aim for beating the market by 5 percentage points, and that's why the big 5 rock is on there, along with the percentage thing. And it's an objective that's pretty common amongst the community. Try to beat the long-term performance of the market by 5 percentage points. So if the market goes up 12% during the lifetime of your investment club or your personal portfolio, you would like to aim for a 17% return. And we have shown that to be feasible. It ain't easy, but that is one of the time-honored traditions of the modern investment club movement. So we will visit that here in a minute. First and foremost, our boilerplate. No investment recommendation whatsoever is intended. This is an educational demonstration intended to illustrate and display the methods and techniques of the modern investment club movement as championed by NEIC Better Investing and is interpreted and also championed by Manifest Investing. Very common platform between the two. And we basically follow the teachings of the grandfather of the modern investment club movement, George Nicholson Jr. And we basically have some opinions that we'll be sharing here and basically just demonstrating, how we look at a company and how we actually achieve this notion of better companies at better prices. In other words, excellent companies, very well managed companies that take advantage of their field of opportunity. And we're really only interested in them when they go on sale and become attractively priced. So that's what it's all about. If we hold a stock that we're talking about, we will try to remember to disclose that. If you'd like to have an email reminder sent to you to remind yourself about this once a month event, which we've been doing now for very close to 12 years, send an email to nkavula1@comcast.net. Just say roundtable reminder in the subject, and Natalie will take care of you. If you have any follow-up questions or would like copies of these slides, send an email to me, Mark R. at manifestinvesting.com. Anything you'd like to add to that, Ken? Or Sal?
Only that we do record everything and it gets posted on YouTube. We do have a YouTube channel. You can search for it under Manifest Investing Roundtable or Better Investing Roundtable. Any of those search trials will get you to the YouTube. We'd love for you to subscribe to our channel, and then everything that we've done, whether it be roundtable or bull session or special conference material, special class material, we've put it in this one section, and it's there for you to take a look at whenever it's convenient. There's a lot of stuff there now. As Mark said, we're coming up on the 12th anniversary of the starting of the roundtable, and a lot of the things on the site do date back to the original start of the program.
All right, here's our standing agenda. We've been basically, again, doing it since 2010. Welcome if you're here for the first time. We do keep it fairly informal. There is a Q&A session at the end, time permitting. We keep track of how well we do. We'll talk about that in a minute. We do take care of the portfolio. It's a little different. It is a tracking portfolio with way more stocks than would traditionally be in a portfolio, but we do demonstrate at least the edges of portfolio design and management as we do that. Here are the 4 stocks for tonight: Rowe Price, VMware, Littelfuse, and LGI Homes. We do have a poll at the end. Even if you're a newcomer here, we encourage everybody to cast their vote, and there may be special prizes for those who vote for my stock tonight. No, I'm kidding. I'm kidding. We don't indulge in that sort of thing. All right. Here's the basic ground rules. We're all trying to share an idea, and the analysis of that idea, subjecting it to what could basically be described as a gauntlet of a fairly short list of things that really matter. And that's basically what we do. We keep track of them. We would like our ideas to beat the stock market as measured by the Wilshire 5000 index by 5 percentage points over the long term. And we'd also like to see the majority of our selections actually outperform that benchmark also. All right. And here's our opportunity for a little round of tilt your glass, tip your glass, or a little cyber applause. We have returned to slightly north of 5%.
We are back, baby. Where'd you find this, Mark?
Well, actually, Jon Stewart is back in a brand new series that's available through Apple. If you're a fan of the old show, he's back in force. And he did a whole section on the economy and the stock market fairly recently. And he was pretty brazen about it, so strap yourself in if you happen to go there. The way you interpret this information, our rate of return, again, we track every single decision made, again, over the last 12 years. If you compile an internal rate of return since July 2010, our rate of return is 17.6. Mirroring investments into the Wilshire 5000 would have returned 12.5. You subtract one from the other, and you get this notion of what we call relative return of 5.1% or percentage points. And it's basically the answer to the question, how much are you beating the market by? And again, that time-honored red dotted line across there is that 5 percentage point target. So I guess we just say huzzah and move on.
Huzzah, huzzah, huzzah. Go on, Si. Yeah.
I was just going to ask, are the circles that bounce around, are those the rocks from Stonehenge? Or?
Which circles?
The monthly.
All the monthlies? Well,
returns.
it could be. I hope we don't circle back to -2 though. All right, let's
So
keep going.
it's been a long time getting back up above that. That's almost a year, isn't it? That we kind of sag below the 5 line.
Yeah, there were a couple major culprits, including Ardelyx, that helped to do that. I think our next objective should be, kind of like Elon Musk when he talks about Mars. We should aim for that 8% level and try to get to a new all-time high.
Yeah.
All right, I'm all for it, Mark.
I would not. I don't want to overstate things.
I was kidding. I was kidding.
But but one thing that we have observed, anecdotally at least, about the better investing methodology is that it tends to underperform a little bit in super hot markets and outperform in down markets. And you can see that a little bit in the longer term trend. And when you have a long, we coming out of the Great Recession, we're doing well and so forth. But in the last year, and really the last 4+ years have been so volatile. And again, the last year has been kind of the market on the skids a bit with the inflation and now the war and that sort of thing. And our relative return has come up.
Yeah,
Mark, we have a couple of folks in the audience that are not quite sure what you mean by a mirroring investment. Could you be a little bit more clear on this of this comparison between our rate of return and the Wilshire 5000?
Right. For any decision we make, like tonight, I will nominate LGI Homes, and that selection will mean that we will place $1,000 into LGI Homes. At the same time, we make a $1,000 investment in the Wilshire 5000, and then we track those $2,000 amounts basically side by side. That's what's referred to as a mirroring investment. So, that's done for every single investment every decision that we make.
Right. So every single decision that we make is separately tracked, and then we kind of combine it all to come up with a composite of what the portfolio is doing versus what the same dollar amount put into the Wilshire 5000 at the same time periods would be doing, right?
That's correct.
Good.
That leads us into what's actually in the portfolio after 12 years. And these are the top 20 positions by percent of total assets. So the bigger positions are at the top, Microsoft being our largest position. And it's quite dominant. The way that you break this down and decode it is we keep track of how many times we invest in the company. Here's Microsoft up here. It's actually been chosen 5 times. So that means $5,000 has been invested in Microsoft. That $5,000 has become $79,000. So for any of the listings on here, there's, I think, just one at the top or near the top. Costco is a single time selection. Amazon is a 2-time selection. There's a couple like that. But for the others that have multiple repeat selections, and 3 of our selections tonight are repeat with 1 brand new one, you can actually break it down. If you want to see all, I think there's about approximately 80 positions in the portfolio. You can actually go to that public link at the bottom, dashboards/public/roundtable, and you can see the entire portfolio from the largest position down to the smallest. Anything grab you?
Yeah, I think the most interesting one on the list right now, Mark, is one that had disappeared from the list last month, and now it's back on in a pretty strong position. That's EPAM. EPAM is a company that it's a United States company. It's an American company, but it has a lot of its employee base from Belarus, Russia, and the Ukraine. And when that war began, those employees suddenly found that they were having a very difficult time working, as you might imagine. EPAM has been extremely volatile. I noticed that today my EPAM holding, and I didn't bail from the company in the two places where I hold it. I held on to my EPAM stock, and today it was up something like 12, 13%, but it's been down that much or more over the last 4 or 5 weeks. I'm pleased to see that the 7-time choice, which means we put $7,000 in it, is still worth double that value plus. It's still worth $16,699. So it's just this was one of Cy's favorites, and it still warrants a really good place on this list, Cy.
I see that, and I noticed too the bounce back that it had in the last few weeks, and notice a few of the audience are mentioning that it's up even today from this amount. But kind of y'all may remember that I picked the Five Below when all the stores were closed at the start of the pandemic shutdown. And I wish now, in retrospect, it's always good. Hindsight's always good that I had picked more EPAM last month when the war was going on, because it's up over 50% from the low last month. So
yeah, you and I talked about that at length at the last roundtable,
yes,
too,
we did.
where we brought in some comments from the CEO that made it clear that they were going to do all that they possibly could for their employees, but they were also out actively recruiting new employees from other parts of the world, and they had every intention of meeting all their contractual obligations. That kind of very confident, positive talk certainly doesn't hurt when you're trying to instill that feeling of confidence in a stock that has lost a lot of its workers through no fault of its own.
Well, Cy never met an information technology or a consulting company that he didn't like. So there's he's had a whole lot of faith rewarded in a number of these companies, including his 15 selections of Cognizant. I think you have almost all of those 15 sides. So let's go ahead and punch on just to take a quick look at the portfolio. And I just kind of horizontalized it versus what some of you are used to, just because I was squeezing way too much information onto one page. Up here at the top, you see that the return forecast on the average stock right now, the average par is approximately 9%. And you can see these are the dollar weighted averages of the positions in the portfolio shown here. So this is the roundtable tracking portfolio with a 11% growth rate, very high quality, decent par, but Cy wants it to be a little higher. And these numbers are all actually pretty good. We always want to strive for a slightly higher return if we're going to make that 18% number anytime soon. All right. Any comments on that, Ken? Or
well, Mark, my wife is in the middle of a long presentation that she's going to make to our investment club tomorrow night on NVIDIA, and I've been her guinea pig, listening to some of the things that she's discovered and some of the new things that NVIDIA is doing, and I would really hesitate to move that holding out of our portfolio. I know that it's coming down to where you can get for cash right now, but I would really hesitate moving any of those three companies out of the portfolio at this time. I think that 11.5% growth is just touching the lower end of what Nicholson said you should be able to grow your sales and still achieve that +5 premium in the portfolio. I would like to see the par up just a little bit too, but 9.1 to 11.9, we're coming up on 3% right now, and I think we just have to focus on adding more and more stocks that have a little bit more par attached to them, and maybe a little bit more sales growth attached to them at the same time.
Yeah, the one thing, and Si will probably want to chime in on this, the one exemption that Nicholson would often talk about is when you're dealing with one where you can actually see that this level of growth is in the company, you want to give that more room to run. The other thing I would point out, it is just 0.3. It's one position. So anything we do with that is not going to dramatically affect this number. So yeah, I think let it run and let Herb Lemkool continue to wallow in the glory.
To bask in the glory, right? Booking, Mark, I think that booking is a really good opening the company, opening the country, opening the world kind of play. And the recent price action has kind of cemented that idea that this is a stock for the future for the next couple of years. And I would hate that we had held it for all this time during the COVID, and then we decide we're going to jettison it just as it starts to really open up to the world and starts to take off again as a true growth company.
Yeah, I would agree. And we probably should explain to those that might be new, this is the challenge hot seat. It's basically the three companies with the lowest projected annual return in the portfolio right now. And again, you want to basically be patient and kind, but also very deliberate in dealing with them.
Yeah. I'll give you a candidate to get rid of, Mark, and I'll nominate my WRAP, WRAP. I don't know what I was thinking in October when I presented that one to the round table, but I'm going to admit my folly and ask you just to very publicly take that out of the portfolio. I think it's probably been cut about in half, right?
Yeah, I just sprinkled it.
In
500.
price.
So yeah. What this
So,
refers to, for those in the audience, we're basically talking about we monitor any pick that we make for fairly dramatic underperformance versus the market. And our definition of where we first begin noticing that is when it falls 20% or more behind the stock market from the time of selection. So we actually have a bunch of 30s and 40s and 50s in here. We've kind of given our Ardelyx a pass. I do find it interesting that Hugh was interested in Ardelyx 7 years ago at 1091. I think we still let that run its course with the story that we talked about over the last couple of months when I added to it. More on that to follow here in a few minutes. But I think I'll also take a closer look at this one. I was equally wrong with Kathy Wood on this one, and that's the Australian New Zealander milk company that's just not working out very well. So maybe I'll wrap that. And
there's one down at the bottom too, Mark.
There's a third one. Oh, that's right.
Wouldn't want you to forget that one either, Mark. So
the audience with me.
Yeah.
So it's just a matter of, and again, we don't need to go into this in any great detail now, but what we have discovered over the years that if a company dramatically underperforms, it's not your fault. It's just that they're not following your instructions and failing on their operational plan, and or they're just not getting any respect. You just have to walk away. Then 1 out of 5 is just going to misbehave, and we generally start taking them out at a 20%, unless we have a special reason to basically hang in there and let them go. Like for instance with Facebook, what's not to like about the company, and it's only 37% behind.
The 37% negative relative return is a pretty good thing.
Mark is quoting the close of one of my Facebook presentations. I don't think it was this one though, Mark. This one, I just got into Facebook way too early on this one, I think.
Okay.
I guess if we're going to move WRAP, we should also decide that Cricket was just not a very good idea either. Kim and I both were off somewhere else in October of 2021, but those two positions in Cricket probably should go as well.
Yeah, we could jettison them, and I think we should make a special note to go back in a couple of years and revisit that night and see what everybody had for dinner or lunch and what we were drinking. Because
the Braves were winning the World Series. That's why I wasn't there to rescue you guys.
Well, that could be it. That could be
You
it.
know, Si, I think this is just what happens during periods of prolonged isolation from other human beings. You know, you, you start to come up with some really strange ideas. So,
There are some serious lessons to be learned there. All right, let's wrap this up with, again, we do monitor the portfolio. We do not act immediately when we see this condition, but anytime a company becomes overbought, a relative strength index greater than 70, we like to see 80, in fact, we just notice that it's hot, and it could be an opportunity to sell. I don't believe any of those are worthy of a selling situation based on these projected returns, based on these projected returns on value. So I think we just move on. There's enough.
so we are going to get rid of those 1, 2, 3, 4, 5, 6 positions based on the rule of 5, right?
Yeah, I'll bring myself to do it.
Okay, great, great.
I finally decided I might go back and actually recapture what Kathy Wood had to say about the milk company, but A2 Milk is the name of the company.
Yep.
All right, and here's NVIDIA. Again, it's just a case of pointing out that this thing is a rocket with boosters, and it's going to have periods like this. We know that those are going to happen. Don't be surprised when they happen. We might be in a mini version of that right now, and left to right, it still looks pretty good. The other thing we like to point out is a company can be overbought for years.
Yeah. I told you that Natalie's preparing a pretty deep dive for our investment group tomorrow, and she's captured some things that, from her point of view at least, and she's pretty savvy on picking up on future trends. She thinks that NVIDIA is just positioned perfectly for all kinds of things that we don't even know we need yet. And that's the kind of technology that really makes a lot of money in the next 4, 5, 6 years. If you don't even know you need it yet today, and yet it'll be something that everybody wants 3 years from now. So she's really, really sold on this company, even at the elevated price.
I'll be interested in what she has to say about the blockchain integration and that kind of stuff with NVIDIA, because it's my understanding they're a front runner in that area also.
Well, it's one of their chips, Mark, is almost essential to do the blockchain mining, to do the Bitcoin mining. And that's where a huge amount of their revenue is coming from right now in these chips that they're selling all over the world for people that want to mine Bitcoin.
Absolutely. All right. Well, we'll look forward to that update at a bull session or a future roundtable. All right. Just a quick commercial for next month's roundtable, April 26th. It will be that special program. I think Candace is in the audience. Hello, Candace. Coming to you not from St. Louis, but sort of, at least cyber from St. Louis. And we're going to do a two-part program. Ken, how did you have that laid out for the audience?
Well, what we're going to do next month at the roundtable is we're going to co-sponsor the roundtable. We already co-sponsor it with Manifest Investing and the Better Investing Mid-Michigan chapter, and we're going to invite the St. Louis chapter to co-sponsor with us as well at 7:30 p.m. Eastern Time. That would be 6:30 Central, where St. Louis is. We're going to start the April roundtable with a class. We've come up with a title, and we think we have a pretty good class in preparation. We're going to call it, help me out, Mark.
Celebrating our workhorses.
Celebrating the workhorses, right? And we're going to not, as you might expect, focus on Clydesdales, but we're going to focus on the medium-sized stocks that are in our portfolios that Mr. Nicholson in particular characterized as being the workhorses of the portfolio. We're going to talk about them. We think they get a little bit short shrift an awful lot of times. We spend a lot of time talking about small companies and a fair amount of time talking about the larger, more well-known companies, but we're going to move and feature some of the workhorse companies that maybe you are familiar with, maybe you aren't as familiar with them as you might be. We're going to run that class until 20 after 8 Eastern Time. We're going to take a 10-minute break, and then we're going to start the traditional roundtable program at 8:30, and it'll go to around 9:45. We hope that our St. Louis friends will join us. We're going to send all the publicity to St. Louis chapters so they can put it on their website and send out emails and all kinds of things. And let's see if we can boost our attendance by another maybe 80 or 100 people. That would be really, really nice to be able to do. So next last Tuesday of the month, April 26th, the roundtable sponsored by the Mid-Michigan chapter and the St. Louis chapter of Better Investing, and of course Manifest Investing with Mark Robertson and Cy Lynch, myself, and we hope that we might have Hugh McManus with us, and if not, we'll do our very best to come up with some more folks. We'll have a special guest damsel in Candace Baker. Some of you might know Candace. She's been a volunteer, a long time Better Investing volunteer for maybe as much as 20, 25 years. And Candace will be offering her thoughts on a stock to place in motion for the portfolio, as well as one coming from Mark and Cy and myself and maybe you. So it'll be a good time, Mark.
All right. Thanks. Well, now that you're all out of breath, go ahead and take us away on Rowe Price.
Well, this is going to be short and sweet. I went to the Rowe Price website and I found the corporate profile on the first page of their website, and I thought it captured very, very succinctly what this company does. So I'll give you time to read while I talk just a little bit about what I was looking for this month when I was trying to come up with a stock for the portfolio. I'm feeling a little bit jittery. I'm feeling a little bit antsy about where the market's going to go next. What's it going to do? This volatility is extreme on some days, and it's I must admit a little bit off-putting as far as I'm concerned, and I'm getting a little bit nervous whether the market goes up 300 points or down 700 points, or whether it swings 1,500 points in a single day as it does once or twice in the last couple of months. So I was looking for something that had an extreme safety rating to it. I was looking for a rating of 1 from Value Line, and then I wanted that safety rating to be reinforced from some of the other sources that I take a look at. Value Line's not the only source that rates the safety of a company's balance sheet, a company's finances, and I wanted a really safe company. I wanted one that fit the Better Investing model as perfectly as I could. So I wanted a nice, clean, up, straight, and parallel kind of a graph. And I wanted halfway decent returns. So I had told myself that I'd like to have returns, par returns, average returns in the 14, 15, 16% range. I set those ideas in motion and started doing some screening. I did some screening on the Better Investing site. I did a lot of screening on the Manifest site, and Rowe Price was the company that just rose to the top like cream in a bottle of fresh milk. It was meeting all the criteria that I had set for the kind of stock that I was looking for. Amazingly, I do not own Rowe Price, but after reading a little bit about it and after talking to my wife about it, this might very well become one of the newest members of either her IRA or my IRA. We have some cash to invest, and Rowe Price looks like a nice, safe investment. Next slide, Mark. There's that up, straight, and parallel I was talking about. That's about as straight a sales line and earnings line as you can possibly get. And I like the fact that from about 2016 to the present time, I'm actually seeing the growth exceed the trend lines by just a touch. The trend lines are measured at 9.5% for sales and 15.4% for earnings. And I'm noticing that for the last 6 data points, the growth is probably even a little bit faster than that. I've chose 9% sales growth and 10% earnings growth going forward. And that's after consulting a half dozen different sources, looking at what their opinions are, and then trying to come down on the conservative side of the pack. I'm not looking to be way, way low or way, way high. I'd like to be on the lower side, but still stay to the middle. I'd like my SSG to kind of match my politics, I guess. Next slide. I'm looking at the evaluate management section from the Rowe Price SSG. And even though that third one says red, and red is supposed to mean it's pretty bad, if you check out the numerical data that goes with it, you see that this is debt to capital, and the debt has gone from 0 to 2.7% in the most recent year, and that's not really concerning me. It's a 5-year average of 1.3%. I'm not really worried about debt like that. That's a fantastic return on equity number. Anything over 20 is a real good solid number. And of course, the pre-tax profit numbers for companies like this that manage money and manage assets and do investing and help other people do investing, the profit margins are pretty decent as well. There's that safety rating from Value Line. I circled it after capturing the upper corner of the Value Line page, and Value Line had indicated they felt that for the next 3 to 5 years, I could experience growth somewhere between 10 and 15%. That was within the range that I had decided I would like to see the growth come from. At the bottom of the page, I captured the manifest information on Rowe Price, and I saw the par value for manifest was 15.4 with a quality rating of 100. It doesn't get much safer than that when you have that kind of a balance sheet, and there's that par above 13.14 that I've been talking about. That annual rates box is coming again from Value Line, and they picked revenue growth for the next 3 to 5 years of 11.5%. They picked earnings growth in the next 3 to 5 years of 12.5%. Of course, that's dependent on the number of shares. These rates are per share. And if, in fact, the number of shares should decline because of a buyback, then those numbers would only go up. The two kinds of figures move in opposite directions. So as shares decline, the growth rates actually move up a little bit. I don't anticipate any major change in the number of shares one way or the other to any significant amount. Next slide. Here's the backside, or some of the backside of the SSG, and after checking out the data and keeping in mind that inflation might rear its ugly head, I decided to use PE averages for the next 5 years that were just a little bit lower than the PE average we had experienced for the past 5 years. So I cut the 16.5 down to 15. I cut the 10.4 down to 10. That's a pretty narrow PE range. I get a really nice buy at an upside downside of 8.7 to 1. That's a good upside downside without being unbelievable. And one more click, Mark. And I end up with an SSG that says if I'm going to sell at the average PE for my SSG, that would be about 12.5. 10 plus 15, that's 25, divided by 2, that's 12.5. If I were to sell at 12.5, I'd get about 15% return. If I were lucky enough to sell at the top at 15, then I'd get an 18.5% return. these appreciation numbers include a significant dividend. And the dividend right today with yesterday's price was yielding about 3.2%. So even if I'm a little tiny bit optimistic, I still stand to get 3.2% per year while I'm waiting for things to settle down a little bit and move back to the kind of growth that I know this company can achieve. So I'm going to suggest $1,000 in Rowe Price.
Okay. All right. Should we just skip over VMware and limit the field? Or do we want to?
I think so. I think so. This is Kim's choice, and again, Kim's been called away. This is a repeat choice for Kim, VMware. But let's just skip over VMware, and if you really know about it and like it, you can still vote for it in the poll. But we'll just kind of consider that it wasn't presented this evening.
Yeah, I just would add the footnote that this is a very formidable company. They integrate systems that don't typically talk to each other. They are really leveraged in with all of the major players from Microsoft to Google to Amazon, and the software as a service is a pretty big deal. You can see some of the information that she's sharing from their most recent investor relations presentation. And just to give you a really quick snapshot, I'm pretty sure there's a look at the value line. Again, it's been as high as almost 200. It's back down. Well, it was actually at 206.8. It's back down closer to 100 these days. And again, value line likes it in a big way. It's kind of paused a little bit. And again, there's your thumbnail sketch on the upper right. This company is firing on all cylinders. Very profitable, very consistent, and a whole lot of up, straight, and parallel there. So I can see what grabs her attention and why it's a repeat selection. So with that, let's go ahead and talk Chicago's Littelfuse.
Yes, here we are. I interestingly enough took a similar but slightly different approach that Ken did. I was looking for a new holding to the portfolio and also a super safe or at least super quality portfolio, and Littelfuse is what I came up with. You can see the value line figures with the current price as of today, potential 35% return over the next 18 months, and then between 9 and 20 compound over the next 3 to 5 years. And again, a little bit more volatility because of the business that they are in, but the sales quite consistent and earnings and profitability pretty consistent as well. Next slide. I was looking for top-notch quality. My screening had one criteria, and that was a 99% quality. I used 99%, number one, just to get a little beyond the 100, but also if you're screening on manifest to a very discrete place, sometimes by rounding, you will miss companies that say 100 in the results if you put 100 in your criteria or something similar, just because of rounding. So I use 99. But here's the results ranked by par, and you notice that Rowe Price is there, but I was looking for a new company. Market access is interesting, but it seems a little overpriced right now, particularly with the PE of 46, and I wasn't quite ready to go to the Pacific region, although Taiwan Semiconductor keeps popping up on the screens that I do too. So I settled on Littelfuse. Next slide. Here's a quick industry study ranked by par. You see that it's second in the industry. Next slide. Ranked by quality, there are actually two. This is a high quality industry, as you can see, two 100 quality companies and 299 quality, and then you see a few others on down, and it's the highest return with that quality. So that's what I settled on. Next slide. Here's roughly what the company is. They've been around since 1927, and as you might guess by their name, they are, at least historically, in a very boring, dull, but important industry or business of making fuses, circuit breakers, all sorts of components that go into controlling electrical current. Fuse being the beginning, but they've, of course, over the years expanded into various things. And they are really emphasizing sustainable, connected, and safer world. Here you could see their products, again, starting with fuses, fuse blocks, but then more sexy current things of LEDs, TV diodes. And one thing that I'll mention a bit during the presentation, and analysts, Morningstar and others believe may be one of the great future drivers for the company, is vehicle power distribution, both in traditional internal combustion vehicles, but especially in the electronic vehicle company. And as Mark said, they're headquartered in Chicago. Next slide. Here's just a diagram from the company's latest presentation on who they are, what they do, and how they grow. You've seen largely what they do. They've got 15 different countries that they have operations in, 100,000 plus consumers. And one thing that Littelfuse does seek to grow is strategic acquisitions. About half their projected future growth from the company they expect to do through acquisition, and about half being internally generated. You'll see that in later slides. Next slide. I just put this in to go a bit again with their commitment to sustainability. Again, that sustainable and safe going forward environment, and they do seek to be environmentally friendly. They seek to have a diverse, particularly through encouraging women to be in their leadership, as well as minorities, both at the employment level and the board levels. Next slide. Here is their markets. They operate in 3 segments, and they're all roughly similar in return, as this shows. The transportation, which again, EV vehicles and internal combustion vehicles, as well as EV charging infrastructure. Then the electronics area that they get into, as you can see, data centers and various larger electronic areas. And then their industrial sector, which was what used to be kind of their traditional fuse and so forth. And that's renewable energy, which one of the areas that is expected to be very high growth in the semiconductor industry over the next 5 years is what's called the silicon carbide semiconductors. And those are used for very high capacity, high current using applications. And it's a very competitive industry. You can certainly invest in that industry. But as Diane Grace, one of our longtime friends, often encourages people to do, is to invest in the pick and shovel makers. Don't try and figure out who's going to mine the gold. Sell everybody picks and shovels. That's what Littelfuse does. And that silicon carbide market is another area that they may be able to grow. And it actually is also related to the EV passenger vehicle market, but it's not limited to that application. Next slide. I just threw in a couple of slides from the presentation that shows how they do vehicle controls. This is the traditional vehicles for the internal combustion vehicles. I think Morningstar estimates that they sell about $6 in every vehicle with a cost of around $10,000 if it's internal combustion. Next slide. And then here is the EV vehicles. One reason I decided to go for this company tonight, not really, but it was interesting and why I like these slides. I have now for about 15 months owned a plug-in hybrid Honda. So I really kind of stay in tune with the EV markets and what's going on there. I don't know how much my car has of Littelfuse products, but Morningstar here estimates that about $25 in every 10,000 cost EV is Littelfuse. I mentioned those to show that Littelfuse sells a lot of stuff, many units, because they're very small portions of EV, but this is expected in vehicles, but this is expected to be one of their high growth drivers. Morningstar also sees that as a positive because once they've established a relationship with the automaker, if somebody comes along and says, I'll sell you what Littelfuse is selling you for $23, or they're selling it for $25, I'll cut the price to $23. The customer's not really inclined to change because of all the investment that they already have in the engineering and all of the support by Littelfuse. So next slide. Here is how they project growth over the next 4 years that you could see here. 5 to 7% organic growth. That's internally produced growth. Acquisition between 5 and 7. So that gives you 10 to 14% growth. Earnings to exceed sales growth. Use their cash flow for capital expenditures. And again, much of their cash flow is used for acquisitions. High teens return on invested capital, and return 40% of free cash flow to shareholders through dividends and share buybacks. Next slide. This is just their M&A, mergers and acquisitions priority, since that is projected to be half of their growth. They're accelerating their success in renewables and e-mobility, both passenger and, as well as you could see here, commercial vehicles, penetrating more in the Asian markets, and then increasing their core competencies. Next slide. I projected 12% growth. That's pretty much right there in the middle of the company's goal of 10 to 14%. Left expenses at the 5-year average, which is significantly below the current profit margin. But their profit margin is somewhat volatile, so I was comfortable using the average and be pleasantly surprised if it beats the average, which analysts, and to include again Morningstar Value Line and the Manifest Consensus, are projecting an increased margin. Left shares about the same. Shares for Littelfuse is relatively level over time. They issue shares for various acquisitions and the like, and then buy back shares. So there's not much dilution, but similarly, because they use it for acquisition, there's not significant decrease in shares either due to share buybacks. Next slide. And then here are my final judgments. at a high PE of 35, potential return of 17.5%. At the average PE, and actually I said 20, actually the average would be the average of both of those. The 20 is the low PE, so average would actually be 27.5. That's a typo on my part that I just realized as I looked at that. Gives you a decent return of 12.2%, a little below, again, the manifest consensus par. So I looked for a very safe, dull, boring, yet exciting potential return company, and am adding Littelfuse to our portfolio.
Thanks, Si. Yeah, I go back quite a ways with Littelfuse. John Rogers of Ariel Capital Management gave a series of presentations to the Chicago chapter back approximately 25 years ago. So I'm going to go back. It was one of his favorite companies back then. I suspect it's been in the Ariel portfolio ever since then. I think I'll go back and take a look at how well John Rogers has done with Littelfuse over the years. All right, now I didn't do this for you, Si, but I just want to center in on this theme of if you build it, they will come. And what this is basically going to do is leverage into the discussions that we've heard from Ken Kavula, Matt Spielman, and others about the shortage of housing and the opportunities for those who build houses well. People will come, Ray. They most definitely will come. And the reason that I was inspired to do this is I had done a quick screen, basically trying to do some of the similar type stuff that Si and Ken were describing. And my Sweet 16 included so much stuff from builders of, residential construction to materials that would be involved in it, from top to bottom. These are all pretty compelling returns. They can't all be right, but it certainly is a pretty powerful sign. I think perhaps the investing world has perhaps overreacted a little bit to the smidge of interest rate increases that we just had, and they might be overestimating that impact just a little bit. Housing sales in our area, and again, I see a very small slice of the world, but they are extremely robust. Family member bought a condo a couple of months ago, and there were 16 people waiting in line outside to make an offer while she was in making an offer. So there is a shortage, and looking for companies either in that construction or in the picks and shovels that Si was just talking about makes a lot of sense. So all of these returns are good. All the quality are pretty good. It's a good place to go shopping. You see Matt Spielman's Green Brick Partners on here. You got to finance them too. Ken's First Foundation, which he added to the Best Small Company portfolio this afternoon. That's this one. That's a good study also. But I was just basically drawn to the one with the lowest relative strength index, the most oversold. And I decided to go with this LGI Homes, which will be a repeat selection for the portfolio. A lot like Green Brick, they are out of Texas, and they are very focused on that rim of states, all the way from the West Coast, wrapping all the way around the country through Texas and the Southeast. And they are currently the 10th largest residential builder in America, with their sights set on becoming at least the 5th largest one. And there's just some huge numbers here. Look at these margins and return on equity. This is a well-managed company, and it really does stack up quite favorably next to companies like Green Brick and some of the leading home builders in that top 5. So, interesting thing. Here, this basically shows you that they started out approximately 10 years ago, concentrated in the central South, and have basically expanded out to include Florida, California, the West Coast, and basically that rim of states all the way around the country. And they have a lot of room for growth, and they seem to be very effectively latching on to opportunity. It is a 5-time selection. You can see that Kim has selected it 3 times. The audience has seconded her selection twice. historically. She bought it 5 years ago for the round table at the convention, and then repeated it a couple weeks later. And wow, $30 a share. It's actually had quite a run. It's got an annualized rate of return for Kim of 27 to 28%, beating the market by 12 to 13% since then. The fairly recent selection, and again, this is part of that evidence of, I think, maybe the market is overreacting to the negativity of the interest rate increases. And it's gone from in January at 125 down into the 105 range. So it actually has lost some ground, providing a potential opportunity for all of us. Notice that those $5,000 investments in LGIH are now worth basically $13,000 or $14,000. Here's a quick look at the footprint or the thumbnail for the company, and you can see again it isn't going to be an economically sensitive, a bit cyclical environment, but a very robust sales trend up at the top here. The growth rate on display here, which certainly seems achievable and feasible, is in the 15% range. So this is a $3 billion company, again, growing in that wide berth of states across the rim of the country, growing at 15%, could become a $6 billion company in approximately 5 years. How's the profitability? If you take a look at the operating margin, it has been increasing, showing greater efficiency. Basically seems to be stabilizing somewhere in that 20-ish area. I used 18 for now, just for kicks. How does that compare to the net margin, which would be farther down the income statement? The net margin, which would be after all taxes and all financial items in there, basically the bottom line, checks in right around 13 or 14%. That also has been relatively stable. So we'll use 13. That gives us an outlook of a PE, or excuse me, projected earnings per share of approximately $35 5 years out. The PE ratio, checking in at about 8. You can see that historically it has been maturing a little bit, but something in that 7 to 9 range definitely still makes sense. And most analysts actually have it up closer to 10. I basically went with 8. So under those conditions, you're looking at a projected annual return somewhere in that 20-ish range, 20%, and an excellent quality rating. Double checking against the actual capital structure of the company, putting it through its paces for the projected return on value. You can see they have a reasonable number of total liabilities, fairly decent cash on hand, and a very compelling 33% projected return on value. I think that's actually a little bit steep. They do show as oversold, possibly a little bit of an overreaction with the recent drop in price. You can see that drop in price is actually down from a high closer to 200 here, and they're down approaching closer to 100 now. So they've been ratcheted down a little bit. The debt's really hard to come up with, the long-term debt and the amount of interest that they're paying, but they're only paying a couple of percentage points above LIBOR, or LIBOR, I guess is how you would say that, and it's all included in their operating costs, so it's a little bit hard to tell. Another check that we run on the companies that we run through the gauntlet is how close are they trading to their 52-week low. The 52-week low for LGIH is 99.45. You can see that they're down fairly close to it. We like to see that number less than 20%. They are not in the Value Line Standard Edition yet. I predict that they will be. As the 10th largest home builder, I think they will actually make it into the Standard Edition here fairly soon. And last but not least, Morningstar gives them a fair value of approximately $150 a share, which means that they're on sale by as much as 30%. So again, very decent up, straight and parallel situation up here with the sales. Earnings appear to have plateaued a little bit. They are impacted, like anybody that's in that business, by supply chain issues. But again, it's not their first rodeo, so I have a lot of faith that they'll figure that out. So I'm going to go ahead and go with LGIH Homes. All right, so Ken, we're about ready for the poll. I'm hoping that you will include LGI Homes in the candidates this month. I did want to remind
Oh,
everybody that
you're just terrible, Mark.
yeah,
Okay.
a certain company was left off the list last month, and I just want you to look what's happened since then, just to kind of rub salt in the wound a little bit there. All right, Ken, all kidding aside, I volunteered, I'll admit it, to sit up.
All right, let's get this poll up here, Mark, and here we go.
I do think the people should be allowed to vote twice for me because I was left off last month, Ken.
You can't change what they're doing, Mark. I'm sorry. Okay, we have almost 80% of you voting. We'd love to get the voting up around 90. Let's give it about 10 or 12 more seconds. It doesn't cost anything. It just takes a little bit of effort. If you have a touch screen, just touch what you'd like to vote. If not, use your mouse. And there, we just hit 90. So I'm going to close the poll. And I'm going to share the results. And I'm going to suggest, Mark, that we take two positions. It looks like we have almost a dead heat between Littelfuse and Rowe Price Group, 38 and 37. So in the past, we've taken and not tried to split hairs. We've given them each an extra $1,000. So let's give that a try with these two very worthy companies. In fact, I'm pretty pleased with all four of these companies tonight.
Yeah, not like the time we did rap and cricket and
Rapid cricket and whatever. Yeah. All right.
No,
So I'm back to Mark. I'm back to the live screen, so you can go where you want. And meanwhile, I'm going to unmute its initials, MF O'Neill. So I'm going to unmute you. You'll have to unmute yourself. You're self-muted, and we'll listen to what you have to say. MF O'Neill, if you want to speak, your hand's in the air, and you'll have to unmute yourself. There you go.
I'm sorry, that was a mistake.
An inadvertent hand. Okay, thank you.
she was.
All right, Mark, go on.
I think she probably wanted to say that she was sorry that Mark didn't win the poll again this month.
That I'm sure that was it.
Probably.
Okay.
That was, I was just going to give an advertent hand to the winning stocks for tonight. So.
All right, here's your reminder that we archive all of these sessions on YouTube. Just go to YouTube. You can enter Manifest Investing Roundtable. You'll get this page. If you can't find it, send me an email, and we'll help you find it. We do put all of the roundtables and all of the special editions, and Sean has been adding some quick shorts that are less than 60 seconds long. So check those out. We would greatly appreciate it if you'd subscribe. If you subscribe, we basically notify you anytime new content is added, and that will actually enable us to do some things if we get enough subscribers. Don't have a lot of sessions as far as coming attractions. I'll try to build this list out because we do have discussions with a number of different communities around the country going on, and we do have Dallas coming up in June, so we'll get this list up. We do both sessions every Tuesday at 2. You can always find them using that link at the bottom, manifestinvesting.com/events. And then, of course, we do have that reminder about the roundtable coming up in St. Louis. So, Ken, any closing thoughts? I think we were doing pretty good on time if you want to.
We are. We have a couple of interesting questions I'd like to bring up after we close down, Mark, but I hope to see you all at the April Roundtable, sponsored by St. Louis Chapter Better Investing, Mid-Michigan Chapter Better Investing, and of course our friends at Manifest Investing. And a special guest, Candace Baker, will be with us. Candace is well known to the St. Louis group of folks, and we hope she'll become well known to the Mid-Michigan and to the Roundtable groups of folks as well.
All right. Well, thanks, everybody. We'll stick around for some questions.